You've been watching the same listing for 3 months. The house is still there. The price hasn't moved. But every time you check the mortgage calculator, the monthly payment is different. Up $80 this week. Down $40 the next. You're not imagining it, and it has almost nothing to do with the house. And almost everything to do with a market most people have never paid attention to in their life. The bond market. It sounds boring. It sounds like something for retirees and pension funds. But right now, in 2026, it's the single biggest reason your mortgage rate keeps moving. And most people trying to buy a home have no idea how the connection actually works. My name is Nick, and today we're breaking down exactly how the bond market connects to your mortgage rate. What's been happening in 2026 specifically, and why that connection matters more right now than it has in years. Let's start with the core mechanism, because once you see it, the headlines stop being confusing. Mortgage rates aren't set directly by the Federal Reserve. That's the most common misconception. The Fed sets short-term rates. The rate banks charge each other overnight. Mortgages are long-term loans, typically 30 years, and long-term loans track much more closely with long-term bonds, specifically the 10-year Treasury yield. When investors buy a 10-year Treasury bond, they're lending money to the government for 10 years at a fixed rate. Mortgage lenders look at that rate as their baseline, then add a margin on top, to account for the additional risk of lending to an individual homeowner instead of the government. So when the 10-year Treasury yield moves, mortgage rates tend to move with it, usually within days, sometimes within hours. Here's the part that confuses almost everyone the first time they hear it. Bond prices and bond yields move in opposite directions. Think of a bond as a fixed IOU. It promises to pay you a specific amount of interest. If that bond is currently priced low, the fixed interest payment represents a higher percentage return, a higher yield. If investors bid the price up, that same fixed payment now represents a lower percentage, a lower yield. So when bond prices fall, yields rise. And when yields rise, mortgage rates tend to rise right along with them. This is the entire chain reaction, start to finish. Now let's talk about what's actually been happening in 2026 specifically, because this year has been unusually turbulent for bonds. A combination of factors converged at once. Persistent inflation tied partly to energy price disruptions connected to geopolitical tension. A labor market that stayed surprisingly resilient instead of cooling off. And a Federal Reserve under new leadership that has signaled it's more focused on fighting inflation than supporting growth. The 10-year Treasury yield, which had spent a long stretch trading in roughly the 4% to 4.5% range, pushed toward the higher end of that band. As markets priced in the possibility of rate hikes rather than the rate cuts many had expected earlier in the year. That's the headline mechanism behind the bond market breaking framing you might be seeing. It's not breaking in the sense of collapsing. It's breaking out of the relatively calm, narrow trading range it had settled into, and reacting to a genuinely uncertain mix of inflation and growth signals. So translate that directly into what it means for your mortgage. When the 10-year Treasury yield sits near the top of its recent range, closer to 4.5% than 4%, mortgage rates for a typical 30-year fixed loan tend to sit meaningfully higher than they would if the yield were near the bottom of the range. On a $400,000 mortgage, even a half-point difference in your rate can shift your monthly payment by well over $100, and shift your total interest paid over the life of the loan by tens of thousands of dollars. This is why the listing price on that house you've been watching hasn't changed, but the calculator keeps spitting out a different number. The house is the same. The cost of borrowing the money to buy it is what's moving underneath you. Here's the deeper piece almost nobody connects. Why does inflation push bond yields up in the first place? Bond investors are lending money for years into the future, and they're being repaid in fixed dollar amounts. If inflation is running hot, those future fixed payments are worth less in real purchasing power by the time they arrive. So investors demand a higher yield upfront to compensate for that erosion, which means bond prices have to fall to deliver that higher yield. In 2026, energy-related inflation tied to geopolitical disruption has been a major driver of this exact dynamic. Oil price spikes ripple through the entire economy, push headline inflation higher. And that inflation expectation gets priced directly into bond yields, which then flows straight into the mortgage rate you're being quoted. This is also where the Federal Reserve comes back into the picture, just not in the way most people assume. The Fed's main lever is the short-term federal funds rate. In 2026, the Fed has held that rate steady for several meetings running, after markets had spent much of the year expecting cuts. New leadership at the Fed has been notably vocal about prioritizing inflation control, even using strong language about committing to price stability, which markets interpreted as raising the odds of holding rates higher for longer, or even hiking rather than cutting. That signal alone, words, not even an actual rate change, moved bond yields. Because bond markets are constantly pricing in expectations about the future, not just reacting to what's already happened. So your mortgage rate today is being shaped by what investors expect the Fed to do 6 months from now, filtered through the bond market, more than by what the Fed has actually done this week. So what does all of this actually mean if you're the one trying to buy a house or refinance right now? First, stop expecting mortgage rates to be stable just because the underlying economy seems fine on the surface. 2026 has shown that geopolitical shocks, energy price swings, and shifting Fed communication can move the 10-year yield and your rate quote meaningfully within a matter of weeks. Second, a rate quote you get today is not a rate quote you're guaranteed tomorrow. If you're far enough along in a purchase to lock a rate, locking removes you from this volatility for the length of the lock period, typically 30 to 60 days, which can be worth real money if yields are trending upward. Third, the popular narrative of wait for rates to drop before buying assumes a level of predictability that 2020 SIXS bond market simply hasn't delivered. Multiple major forecasters have published meaningfully different year-end predictions for the 10-year yield this year. Some expecting it to ease toward 3.75%, others expecting it to stay anchored in the 4.25% to 4.5% range. Nobody is calling this with confidence right now. Here's the perspective that actually helps, instead of just adding to the noise. You don't need to predict the bond market to make a good housing decision. You need to understand the mechanism well enough to know that rate volatility right now isn't random, isn't a sign anything is fundamentally broken, and isn't something a mortgage calculator glitch is causing. It's the visible result of millions of bond investors, every single day, repricing risk and inflation expectations in real time. And your mortgage rate is just the place where all of that pricing finally reaches your kitchen table. Once you see the chain, inflation expectations, bond yields, then mortgage rates, the moving number on your calculator stops feeling like chaos. It starts looking like exactly what it is, a market doing its job. Even when its job is making your life mildly more complicated this particular year. The house didn't change. The bond market did. And now you know why. Closing, host's final direct address. End card, channel brand.